What is the PEG ratio? The PEG ratio stands for price to earnings to growth ratio. It takes the PE ratio, price compared to earnings, and adjusts it for how fast the company's earnings are expected to grow. The formula is simple. PEG is equal to PE ratio divided by earnings growth rate. In plain English, it helps answer, am I paying too much for this company given how quickly it's growing? Why does it matter? The PEG ratio is useful because it adds a layer of perspective. The PE ratio on its own might look high, but if earnings are expected to grow quickly, that high PE could actually be reasonable. For investors, this matters emotionally as well as practically. Instead of worrying, is this share overpriced? The PEG ratio helps you see whether the price tag makes sense compared to growth expectations. It also introduces an important way of thinking. Companies with higher PE can sometimes still be good value if their growth justifies it. That's why PEG is often used for growth companies, while PE is still common for value companies. Here's a simple example. Imagine two companies, both with a PE ratio of 20. Company A's earnings are expected to grow by 20% per year. Its PEG ratio is 1, 20 divided by 20. Company B's earnings are expected to grow by 10% per year. Its PEG ratio is 2, 20 divided by 10. Even though both have the same PE, Company A looks better value for its growth. Company B is more expensive once you consider how slowly it's expected to grow. As a rule of thumb, PEG below 1 may be undervalued, PEG around 1, fair value PEG above 1 may be expensive. These are only guidelines, not hard rules. What else should you know? The PEG ratio relies on earnings growth forecasts, and those are never guaranteed. Analysts might be too optimistic or too pessimistic, which means the PEG could give a false impression. The time frame also matters. Some PEG ratios use short-term forecasts, 1 to 2 years, while others use longer-term expectations, 3 to 5 years. The shorter the period, the more volatile and unreliable the number can be. It also works better for growth companies than for mature, steady businesses. For example, a utility company with slow but stable earnings may look expensive on PEG, even if it's reliable and pays strong dividends. Another limitation, if a company has negative earnings or negative growth, the PEG ratio breaks down and isn't meaningful. Finally, remember it's not used everywhere. While PE is universal, PEG is more commonly used by growth-focused investors. Wherever you're investing, it's just one tool among many. To sum it all up, the PEG ratio adjusts the PE ratio to take earnings growth into account. It's a growth-aware price tag, helping you see if a share's price is fair when you factor in how quickly profits are expected to rise. But because it depends on forecasts and works best with growth companies, it's not a one-size-fits-all answer. Use it as a guide, not a guarantee. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.